have low vision, or have another print disability which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at nfradioreading.org.
Hello, this is Dasha, and for the next hour I'll be reading from the Friday, August 14th issue of the Wall Street Journal on the Niagara Frontier Radio Reading Service. In U.S. News, Capital Count by Greg Ip, the jobless economic boom has arrived. Patrick Collison, chief executive of digital payments company Stripe, recently polled his 1.5 million followers on X about their economic outlook. Some 13,000 took the survey. On average, they expect economic growth to double over the next 5 years to an average of 4.3%, and employment to fall by around 8%. Think of this as the AI optimist scenario, in which AI vastly increases economic output while making tens of millions of workers redundant. The odds of this forecast coming true are close to nil. Employment almost never collapses by that much, and never when output is skyrocketing. But the magnitudes aren't what matters, it's the direction. And if a jobless boom once seemed far-fetched, it no longer does, because we seem to be in one right now. Admittedly, our main growth measure doesn't look boomy. Real inflation-adjusted gross domestic product growth averaged 2.1% over the last year, in line with the previous year, and a lousy 1.5% annualized in the second quarter. But the stock market delivers a completely different picture. It has bulldozed its way through tariffs, war, higher oil prices, and disappointing GDP to rise 14% this year. Just last week, stocks jumped to a record after Treasury Secretary Scott Bessent said the U.S. and Iran could strike a deal to open the Strait of Hormuz in a day or two. The strait is still closed, but stocks have held on to their records. There are several potential explanations for why the stock market has disconnected from GDP. One is that it's a bubble. Another is that it tells us something about the future, namely that growth is going to accelerate. In a bubble, stock prices typically go up faster than earnings, inflating valuations, i.e. the price-earnings multiple. But in the last year, earnings have risen faster than prices. Exclude Amazon.com and Alphabet, whose results were inflated by investment gains, and earnings were up a stunning 32% in the second quarter so far, according to FactSet. The multiple has thus declined. Much of this, of course, is because of AI, which is driving demand for cloud storage and computer chips. Tariff refunds may also play a part. AI itself may well be in a bubble, but the boom isn't just a tech or AI story. The median earnings growth of S&P 500 companies has accelerated to 13% from 8% 2 years ago, according to Bank of America. The bank calculates that total revenue for the index, excluding energy and financial companies, and adjusted for inflation and currency changes, is up around 8%, much more than GDP. A handful of AI-linked stocks were once driving the market. Not anymore. Banks and small stocks, which are both sensitive to the state of the business cycle, are up much more than big techs. Magnificent 7 this year. Deutsche Bank recently found the phrase broad-based cropping up repeatedly in earnings calls. While I appreciate the impact AI is having on GDP, that can't be the only driver of the loan growth that we're seeing given the industry dispersion and the geographic dispersion, Bill Demchak, chief executive of PNC Financial Services, said. The big picture, then, is that companies across the economy, not just those exposed to AI, are seeing solid demand, and that is translating into extraordinary profit and revenue. But not hiring, which brings us to the jobless part of the jobless boom. We learned last week that total payoffs shrank in July, the 5th time in the past 12 months. Private payroll growth has averaged a little over 50,000 per month for the last year. These sorts of trends are virtually unprecedented outside recessions. The slide in job growth hasn't pushed up the unemployment rate, which hovers just above 4%. The reason is that the labor force is shrinking as baby boomers continue to retire and immigration dries up. Demographic factors may be holding down unemployment, yet demand for labor is also tepid. Job openings are mired at post-pandemic lows, according to Indeed. If employers were competing for talent, we'd see it in pay, yet annual earnings growth is just 3.2%, the lowest since before the pandemic. Lots could interfere with the economy unfolding the way the stock market seems to hope. Consumer demand has remained solid despite weak wages because so many households have been saving less, and private investment depends on the issuance of hundreds of billions of dollars of debt to finance data centers. Neither of those things can go on forever, but they can keep going for now, especially if AI accomplishes even a fraction of what the optimists think. Jobless claims continue to rise in the U.S., moving higher than expected last week. The number of people who filed for unemployment benefits was 209,000 in the week through August 8th, 9,000 higher than the upwardly revised 200,000 reported a week earlier, the Labor Department said Thursday. Economists surveyed by the Wall Street Journal had been expecting to see the figure raise to 204,000. Continuing claims, which scale with the total size of the unemployed population, totaled 1.78 million in the week through August 1st, falling 22,000 from the downwardly revised 1.8 million a week earlier. The data on continuing claims lagged the initial claims data by a week. Companies have slowed hiring, and total payrolls shrank last month as demand for labor cools. This was by Dean Seal. Jessica Kawaki offers producer price index flat in July. Wholesale prices were unchanged last month as energy prices edged down, the Labor Department said on Thursday. The producer price index was flat in July after falling by 0.1% in June. Analysts surveyed by the Wall Street Journal had been estimating producer prices to rise by 0.2% last month. The data comes after the July consumer inflation report on Wednesday showed the annual inflation rate fell slightly, easing concerns that the central bank would have to act sooner rather than later at its next interest rate meeting this fall. Economists and Fed officials typically watch the PPI numbers closely because some of the underlying data is used in calculating the personal consumption expenditures price index, the inflation metric that the Federal Reserve uses to gauge progress against its 2% inflation target. The PCE report will arrive later this month. After seeing Wednesday's consumer inflation numbers, many economists estimated that the core version of the PCE index, which excludes volatile food and energy prices, rose by 0.2% or 0.3% last month. The British economy posted a strong quarter by Ed Frankel. The British economy continued its resilient start to the year in the second quarter, growing faster than the U.S. despite the jump in energy prices and heightened uncertainty provoked by the war in the Middle East. Gross domestic product growth was 0.4% in the 3 months through June, the UK's statistics agency said Thursday, matching a consensus of economists polled by the Wall Street Journal. It follows a 0.6% rise in the first quarter, the fastest among the group of 7 leading industrialized nations. However, like elsewhere, the closure of the Strait of Hormuz slowed activity as fuel prices surged, leading to economists slashing growth expectations for the year. Still, on an annualized basis, UK growth was 1.7% in the second quarter, stronger than the US's 1.5% and only slightly lower than the Eurozone's 1.8%. Services were once again the main driver of growth, while production was broadly unchanged and construction also grew, Office for National Statistics Director of Economic Statistics Liz McCune said. The level of economic activity also outpaced forecasts by the Bank of England, which held its key rate last month as it weighed the impact of the jump in oil and gas prices since March. Investors expect the central bank to hold borrowing costs at its next meeting in September, but raise rates at least once before the end of the year. On the opinion page, Lincoln Fillmore, who is a Republican Utah state senator, offers this. A Yale professor has ideas about your kids. I almost didn't believe what I heard. Samuel Moyne, a professor at Yale Law School, told an interviewer that parents can't be trusted because they have a, quote, divergence of interest, unquote, with their own children. He suggests assigning extra weight to the ballots of, quote, the youngest eligible voters, end quote. Strangers to the children, lest children continue to be, quote, hostages of their parents, end quote. Maybe I associate too much with loving and devoted parents and not enough with intellectuals who think parents are holding their kids hostage. In my own life, I recognize that my children's interests and my own regularly diverge. That's part of being a parent. This week, my daughter wanted to play Uno while I was in the middle of working, a clear divergence of interest. We played Uno. That's what parents do, sacrifice for their children. There are exceptions. Some parents fail in their responsibility. Our laws rightly protect children in those circumstances, but when tragic exceptions become the foundation of public policy, we create unintended consequences far more damaging than addressing those exceptions directly. Living in a free society requires us to begin by assuming that parents act in their children's best interests. If we stop trusting parents with their children, someone must take their place. Schools? Government? Law professors and 19-year-olds? Except the youngest eligible voters, Mr. Moyne favors, may possess valuable knowledge, but all inevitably carry their own biases, and none have the intimate understanding, sustained commitment, or enduring responsibility that parents have for their children. Utah law explicitly states that parents bear the primary responsibility for educating children. When parents enroll a child in school, they aren't transferring responsibility, but choosing a partner to help fulfill it. The parents are the primary partners because they are responsible for the children's education and well-being. Authority should follow from responsibility. Teachers offer professional knowledge. School leaders offer experience. Parents offer something neither can, an intimate knowledge of their own child and a lifelong commitment to that child's flourishing. Educational choice matters because one child may thrive in a highly structured classroom, while another flourishes in a school built around the arts, project-based learning, or career and technical education. No single option will be the best for every child, and no statewide system can know those children the way their parents do. The strongest schools understand they are joining families in a shared mission. For children and schools to succeed, educators and parents should be on the same team, each fulfilling their role for the benefit of the child. But we must be clear that the parents are in charge. Trusting parents isn't naive, it's an acknowledgement of a simple truth. No government official, no school administrator, no distant expert, no random young voter will ever match a parent's depth of understanding, love, or willingness to sacrifice when navigating the inevitable diverging interests between parent and child. In the Political Economics column by Joseph C. Sternberg, entitled, "Is Congress About to Reform Social Security?" You may be surprised to hear that Congress is getting serious, after a fashion, about Social Security reform. You won't be at all surprised to learn that this is taking the form of an attempt to pass the responsibility to someone else. Questions about the future of America's largest social welfare program have assumed new urgency in recent months. The latest annual report from the program's trustees, released in June, pulled forward by another few months the date at which the old age portion of the program will run out of funds. That doomsday is now officially in 2032. If Congress resorts to plundering the disability portion, the two together will hobble on only into 2034. Under current law, once the programs have exhausted their current trust funds, benefits would fall to match current revenue from the payroll tax. That would require an estimated 22% cut in benefits overnight for retirees. Should it happen, it would constitute what's known in technical political science jargon as a disaster for anyone unfortunate enough to be serving in Congress at the time. Cue the latest flurry of activity on Capitol Hill. The emerging consensus appears to be that lawmakers doubt their capacity to reach a consensus. They propose instead to form a study committee of some sort to tell them what to do. The Senate version would deputize the existing Social Security Advisory Board, a panel of technocratic experts that normally labors in obscurity, producing reports on how to manage the programs more efficiently, to craft a wholesale reform of the entitlement. That panel would write a reform bill that Congress would have to consider on an expedited basis, although lawmakers would be free to amend it at will. The House iteration of the idea would involve the creation of a new, more overtly political panel with 13 members appointed by the President and House and Senate leaders. If at least 9 of this board's members could agree on a reform package, it would be fast-tracked to an up or down vote in Congress with no opportunities for amendments. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Back to the political economics column. Take seriously the desire of the lawmakers involved to include the Republican Tom Cole and Democrat Tom Suozzi in the House, and Republicans Bill Cassidy, Tom Tillis, and John Cornyn, Democrats Dick Durbin and Tim Kaine, and Independent Angus King in the Senate, to address the looming instability of the old age problem. Alas for them, their plans are unlikely to work. The challenge confronting Social Security has been obvious for several decades. The program has become an unsustainable drag on public finances as lifespans extend. The demographic balance of the population tilts toward the elderly, baby boomers retire, and the design of the retirement program ratchets up benefit payouts. We are approaching the limit of the burden we've already agreed as a polity to bear, and the means we've agreed on to spread the load between current workers and retirees. That agreement is embodied by Social Security's deceptive, quote, trust funds. They aren't really trust funds at all. They are instead a convoluted accounting gimmick that has the effect of capping the fiscal burden on current taxpayers of benefit payouts at an amount equal to the cumulative tax payments the baby boomers made into the system. This is why, when the trust funds run dry, payments will fall. We need a new political agreement. It's a very simple math problem. Current workers will have to bear a higher burden to sustain current benefit levels via increased taxes and further delays into the retirement age. Or current retirees will have to accept lower benefits in the form of means testing benefits, increased taxation of Social Security checks, or slower increases in future payouts, or some combination of these. There are no other options. It's a political rather than a technocratic issue, which is why the proposals for outside panels to solve it for lawmakers miss the mark. Because such a panel would struggle to discern solutions that haven't already been contemplated over the decades, its work would devolve to guessing at a political balance among competing interests that voters might find tolerable. Any reform plan from a committee would still require lawmakers to cast a difficult vote, exposing them to charges of overtaxing working Americans or stiffing retirees. That the plan was concocted by an unelected committee is unlikely to offer much political cover in the end. If such a panel could devise a settlement lawmakers would be prepared to risk voting for, lawmakers already would have crafted such an agreement themselves. That a bloated entitlement is tough to reform isn't news. The unusual feature here, unique among entitlements in the world's major economies, is that Congress is required to try. Normally, entitlements quietly grow apace, consuming ever more resources, but without triggering a political crisis sufficient to prompt reform. The trust fund gimmick, in contrast, creates an unavoidable deadline for reform, which ultimately is a reason to be forgiving of Congress. Whatever lawmakers' first unsatisfactory instincts, they eventually will have to do their jobs. Under Review and Outlook on the opinion pages, UWM is a government mortgage canary. The risks that investors and regulators aren't watching are usually the ones that jump up and bite. An example came last week when billionaire Matt Ishbia's United Wholesale Mortgage, UWM, one of the country's largest mortgage lenders, required a $2 billion private capital infusion after his interest rate hedge went south. The bigger story is how Mr. Ishbia is getting rich from making risky mortgages backed by taxpayers. After the housing meltdown, Big banks pulled back from the mortgage market as the government required them to hold more capital. Non-banks filled the gap, though they don't have to abide rigorous capital, liquidity, and stress tests like banks. They can also game financial regulations with interest rate hedges. That can make them more likely to get into trouble, as UWM shows. Non-banks originate the vast majority of loans backed by the Federal Housing Administration, FHA, and the two giant government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac. These loans are pooled and sold to private investors with government guarantees. This lending system invites moral hazard as non-banks make money by originating more mortgages. But if a borrower later defaults, taxpayers are on the hook. Early in the pandemic, as mortgage rates plunged, lenders competed for business by easing underwriting standards. When interest rates rose in 2022, lenders further eased their standards. This let them make mortgages to borrowers who wouldn't have otherwise qualified based on their incomes. By late 2022, 70% of FHA borrowers had debt-to-income ratios exceeding 43%, which is generally considered risky. That's up from 28% in 2012 and 60% before the pandemic. As inflation started to bite, defaults increased. At about 15% of FHA borrowers who took out a loan between June 2021 and March 2024 fell seriously delinquent within a year. To prevent foreclosures, Joe Biden's regulators used the FHA Insurance Fund to cover arrears of struggling borrowers and offered to reduce their monthly payments by up to 25% for 3 years. The reprieve reduced foreclosures, but it magnified moral hazard by encouraging lenders to make riskier loans, knowing the government would rescue borrowers. A case in point is UWM, which expanded its FHA lending after the housing market stalled. The result, more defaults. According to FHA data, 21.5% of UWM mortgages over the last 2 years fell seriously delinquent within a year of origination, compared to roughly 11% of its loans in 2022 and 2023. Remarkably, 12 mortgage lenders have even higher one-year serious delinquency rates, including Aegis Mortgage, 27.3%, Top Flight Financial, 24.5%, and Loan United, 23.7%. Most of these lenders also make loans that are guaranteed by Fannie and Freddie, so the FHA data could signal problems in loans guaranteed by the two GSEs. A sample of FHA mortgages recently reviewed by the Housing and Urban Development Department found 76% contained a defect, up from 67% in late 2024. This could reflect stepped-up scrutiny by the Trump team, as well as eased underwriting. Foreclosures remain low, but that's because the FHA continues to cover missed payments for borrowers who default. The FHA ought to make mortgage lenders foot at least some of the costs for defaulted loans. Why should taxpayers backstop a billionaire's risky housing bets? In the letters to the editor column, Adam Burns of Sherman Oaks, California, writes, Gerard Baker is right that socialism is the wrong answer, in the editor-at-large on August 11th. Every number he cites is a scoreboard number, a measure of who holds the claims, and none of them measures what anybody eats. For more than 4 decades, consumption inequality has barely moved. Income at the bottom has roughly doubled in real terms after transfers and taxes, and consumption poverty has fallen from 33.8% in 1980 to 6% in 2022. So why does modern capitalism feel so unfair? Look where the squeeze actually is: housing, healthcare, and college. Then look what those three have in common. The government subsidizes the buyer with one hand and restricts the seller with the other, with mortgage subsidies against zoning, student loans against an accreditation monopoly, and insurance mandates against certificate of need laws and licensing. Subsidized demand chokes supply, and the subsidy lands in price. That isn't capitalism failing, but one policy error committed 3 times in the 3 markets where prices were never allowed to do their jobs. And tariffs are the same instinct, without the disguise, since a tariff is a tax on the American buyer, and the New York Fed found that nearly 90% of the 2025 tariff burden landed on American firms and households. Mr. Baker wants to make capitalism great again. You don't do that by fixing the scoreboard. You do it by growing the pie, which means letting people build houses, train doctors, and open schools. And from Ethan Harris of Westfield, New Jersey, bond investors want the Fed to raise rates. Your editorial, Warsh Makes Markets Do Their Jobs, on August 1, takes a shot at bond traders. Quit whining about the Federal Reserve. Your clients are paying you a lot to make judgments about risks and returns in real time, and it's embarrassing when you complain now that Daddy Fed isn't telling you how to do it. I disagree. The bond market tantrum on Fed Day wasn't because Kevin Warsh refused to offer forward guidance. That change in communication happened 6 weeks earlier at Mr. Warsh's first meeting as chairman. Back then, it triggered almost no movement in long-term yields. In June, the Fed had an easy decision to make: remove the sentence suggesting a bias to ease and get a unanimous vote. In addition, Mr. Warsh introduced a new form of forward guidance, repeatedly pledging allegiance to the 2% inflation target. Markets saw Mr. Warsh's pledges as a signal of a willingness to act tough if needed. The July backdrop was different. This time, the markets were on high alert for a rate hike, and hence were looking for at least a hint of Fed thinking. Against that backdrop, Mr. Warsh's tough talk sounded like a substitute for tough action, rather than a signal of future action. The markets are doing their job. The short end is telling us that the Fed should and likely will hike. At the same time, the long end is increasingly questioning whether Mr. Warsh is willing to take tough action. There are other factors moving the bond market, but last month, Mr. Warsh's credibility was the dominant story. And from the front page of the Wall Street Journal, Tariff Refunds Turbocharge Earnings by Theo Francis and Celia Bernhardt. Tariff refunds have begun rolling into big U.S. companies, in some cases providing a solid boost to earnings. Contrary to warnings that the refund process could prove slow and messy, many companies appear to have received the money with remarkable speed. So far, more than 40 S&P 500 companies have reported some $9.6 billion in refunds in the past quarter or so, including at least $2.1 billion in cash already received. Among the biggest refunds reported so far, Apple at nearly $2.2 billion, Nike at $986 million, FedEx at about $800 million, Amazon.com at $640 million, and General Motors at $500 million. U.S. Customs and Border Protection has received just more than 252,000 refund applications as of July 31st for tariffs declared unlawful by the Supreme Court. The Customs Agency accepted $128.7 billion in refunds for processing, an agency official told the federal court last week. Several companies noted they have already received the full amount they sought or expect to. Nike said it had received $302 million in refunds in the last quarter of its fiscal year ended May 31st, and received almost all of the remaining $684 million by July 15th, when it issued its annual report to shareholders. Other companies have made clear that they are still awaiting the outcome of some refund claims. Fortive, which makes industrial measurement equipment and automation technology, recognized a $4.5 million benefit for tariff refunds received, but said it expected as much as $25 million more in coming periods. Reported refunds don't always reflect money in the bank, and companies are handling the sums in different ways on their financial statements. Some record them only as cash arrives, while others are also reflecting likely payments on their financials. Zebra Technologies, which makes barcode scanners and printers, concluded in the second quarter that it was likely to get a refund of all $73 million in past tariff payments. By the end of its quarter ended July 4th, it had received $14 million in cash, but booked the remainder as a receivable. By July 31st, the company said it had received an additional $27 million in payments. In some cases, refunds have contributed handily to quarterly results. Apple said its tariff refunds contributed 11 cents to per share earnings in the most recent quarter, about 5% of the quarter's total. There is more to this article, but unfortunately I don't have time to read it right now. If you would like to hear the rest of the story, call 716-821-5555 and ask for the U.S. tariff refund story to be read to you. Staff will be happy to do so. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Turning to the business and finance section, World Cup ticket fiasco trips StubHub by Hannah Kruger. The World Cup was supposed to bring a windfall for StubHub. Instead, it wiped out its quarterly profit and left the ticket reseller battling customers angry about fraudulent tickets and slow refunds. Shares tumbled 10% on Thursday after the company reported quarterly expenses jumped 37%, more than offsetting a 33% surge in revenue for the quarter ended June 30th. Chief Executive Eric Baker acknowledged the problems that some buyers had with World Cup tickets. As fans ourselves, we understand the disappointment when these issues occur, he said in response to analyst questions late Wednesday. Our marketplace only works when fans attend an event. Baker pointed to FIFA's mobile ticketing app as a challenge for the company. He described it as a system, quote, put up by the event organizer that was sort of just a bespoke thing for this tournament, not anything that anybody would typically rely on, and said it, quote, added an additional layer of complexity on top of the 75 matches StubHub handled in roughly 2 weeks. The Wall Street Journal reported this week that StubHub was facing a flood of complaints from World Cup fans who bought tickets months in advance, only to be stranded hours before the games. StubHub has blamed World Cup disruptions on what it said were obstacles with FIFA's mobile ticket app. The Journal found that ticketing problems extended beyond the tournament. More than 50 StubHub buyers said in interviews they were denied entry for events despite paying for valid tickets, were sent replacements worse than what they had bought, or spent months fighting StubHub for refunds it had already promised. For many, resolution came only after they hired lawyers or complained in the press. Baker said the overwhelming majority of StubHub buyers experienced no problems with their ticket orders during the World Cup, but acknowledged that there was a small subset of fans who didn't have the experience they wanted and had to get a refund. Now, that's unacceptable to us. We work every day to try and eliminate that. Even one refund is one too many, said Baker. With Thursday's sharp drop, the stock is now down nearly 70% from the price the company fetched in its initial public offering less than a year ago. The results included a loss attributable to common stockholders of around $40,000 or 0 cents a share. Analysts polled by FactSet had projected a profit of 11 cents a share. Polestar dealer claims in suit its U.S. ban was orchestrated by Christopher Otts. The Chinese-owned automaker Polestar orchestrated its recent ban by the U.S. government as, quote, cover for its desire to leave the U.S. market, one of the largest American dealers alleged in a lawsuit filed this week. Prestige Imports of East Hanover, New Jersey, doing business as Prestige Polestar and owned by dealer Matthew Haken, alleges Polestar's decision to exit from the U.S. effectively and wrongfully terminates its state dealer franchise agreement under state law. The lawsuit was filed in a New Jersey state court. The dealership claims it is owed at least $25 million in damages. Polestar, a Sweden-based manufacturer of high-end electric vehicles, announced in June that it would stop selling new vehicles, starting with the 2027 model year, in the U.S. after the Commerce Department denied its request for a waiver. U.S. authorities are enforcing a new, quote, connected vehicles, end quote, rule, aiming to prevent foreign adversaries such as China and Russia from using technologies such as data transmission and cameras in vehicles to spy on Americans. Polestar declined to comment on the litigation. Our focus remains on serving our customers and ensuring they continue to receive the support and service they expect from us, a Polestar spokesman said. The company previously said it had significant dialogue with U.S. authorities about the waiver application and that it plans to focus our investments on markets where we have a strong brand position and ability to achieve profitable growth with a strong weighting toward Europe. About a month before Polestar's exit announcement, the Commerce Department approved a waiver for Volvo cars, which has common Chinese ownership and other links to Polestar, to continue selling its vehicles. The Commerce Department and Polestar have declined to detail the factors in the decision. Haken previously told the Wall Street Journal he finds it baffling that Volvo was able to get approval to continue selling in the U.S., but Polestar wasn't. In the lawsuit filed Wednesday, Haken's business claims Polestar declined to make changes that U.S. authorities wanted, thus ensuring its own demise. Polestar refused to engage with regulators, as Volvo did, and has refused to appeal the government decision, the lawsuit said. Polestar claimed the ban was a force majeure event outside of its control in a July 10th letter to Haken, according to a copy of the letter filed with the lawsuit. A small number of Volvo dealers, Haken among them, were awarded Polestar franchises when the automaker began selling its Polestar 2 in the U.S. in 2020. Haken, who declined to comment, previously told the Journal he had invested millions of dollars to build a standalone Polestar showroom in New Jersey. He halted construction when Polestar announced it would no longer sell in the U.S., he said. Polestar remains a niche player in the small corner of the U.S. market, represented by fully electric cars. It sold 2,221 vehicles from January to July, giving it less than 1% of the EV market in the U.S., according to Motor Intelligence data. In business news, Ørsted said profit fell because of charges and tax costs, by Michael Hennessy. Ørsted reported lower second quarter profit hit by write-downs, but said all projects are on schedule and within planned costs. The Danish renewable energy company said Thursday that quarterly net profits sank to 518 million Danish kroner, $79.9 million, from 3.10 billion kroner previously. Higher taxes and non-cash impairment charges this year because of increases in long-dated U.S. interest rates, as well as last year's gains on asset sales, caused the drop. Operating profit before depreciation, amortization, and impairment losses fell to 5.42 billion kroner from 6.64 billion kroner in the year earlier period. This was above the consensus of 5.10 billion kroner provided by the company. Revenue was up 21% at 20.65 billion kroner, mainly due to higher generation and prices. Ørsted said it made significant progress on its construction portfolio, with all projects proceeding on schedule and within planned costs. The company reaffirmed its guidance for adjusted profit before depreciation, amortization, and impairment losses of above 28 billion kroner. This compares with 25.1 billion kroner in 2025. Ørsted said it plans to reinstate dividend distributions for 2026 with the first distribution next year. The dividend will be announced in the 2026 annual report and will start at a modest level, the company said. Coach brand continues to boost Tapestry, by Catherine Hamilton. Tapestry's Coach brand finished the fiscal year with another standout quarter of sales growth, but investors are worried the company won't be able to keep momentum going for another year. Coach has wowed shareholders this year as its handbags caught on with Gen Z shoppers and found viral success with some products including the Brooklyn bag. But Tapestry struck a note of conservatism Thursday and said it now expected revenue to slow down in the second half of its new fiscal year. Shares of the fashion company fell 16% to $128.38 Thursday. Tapestry, which also owns Kate Spade, expects to generate $8.4 billion to $8.5 billion in sales during the new year, compared with analysts' forecast of $8.47 billion. It anticipates $7.80 to $7.90 in earnings per share, while analysts were looking for $7.87 a share. Tapestry expects revenue will slow to a mid-single-digit percentage in the second half of the year, after rising in the high single digits during the first half, executives told analysts on a call. The guidance assumes Coach's sales growth will start the year at a similar clip to the quarter before, but doesn't require Tapestry to keep up with that same level of growth as the year stretches on, Chief Financial Officer Scott Rose said. Our outlook reflects that confidence, but also discipline in how we give guidance and how we plan, Rose said. Coach sales increased 15% to $1.64 billion in the fiscal fourth quarter, offsetting a 7% decline in Kate Spade revenue. Total sales were up 9% to $1.88 billion, just above analysts' estimates of $1.87 billion. Profit was $347.8 million, or $1.68 a share, compared with a loss of $517.1 million, or $2.49 a share a year earlier. Stripping out certain one-time items, adjusted per-share earnings were $1.32, ahead of the $1.28 anticipated by analysts, according to FactSet. Rowe noted that Tapestry was still navigating macroeconomic uncertainty and changing tariffs, which are expected to result in uneven profitability across quarters. The company expects a modest benefit from tariffs in the first half of the year, which will turn into a headwind in the second half. During the current first quarter, Tapestry expects $1.55 in earnings per share, ahead of the $1.49 a share analysts are anticipating. The company said its board approved a 16% increase to its quarterly dividend at 46.25 cents a share and expects to buy back $1.35 billion in shares this fiscal year under its existing share repurchase authorization. JD.com profit revenue exceed expectations by Tracy Q. JD.com reported better than expected results in the second quarter as the Chinese e-commerce titan made steady progress in narrowing losses at its food delivery business. The online retailer is in recovery mode after its costly entry into China's highly competitive food delivery market a year and a half ago. Aggressive investment to capture market share has hit JD.com's bottom line hard, briefly pushing the company to a loss late last year before it returned to a profit at the start of 2026. The Beijing-based company Thursday said net profit was 7.13 billion yuan, equivalent to $1.06 billion, for the 3 months ending June. That rose 15% from a year earlier and was 40% higher than the previous quarter. Revenue declined 2.9% to 346.40 billion yuan, but still beat market estimates. Analysts had expected net profits of 6.71 billion yuan on revenue of 3.93 billion yuan, according to a FactSet consensus estimate. The results show resilient and high-quality operations, Chief Executive Sandy Chu said. Despite near-term revenue headwinds, we achieved strong bottom-line growth, marking a clear inflection in our profit trajectory, Xu said. This improvement was primarily driven by solid profitability in our core JD retail business and continued narrowing of loss at JD Food Delivery. Hapag-Lloyd's earnings recover by Amy Look. Hapag-Lloyd's earnings recovered in the second quarter, driven by strong exports out of Asia and improved U.S. demand. The German shipping company reported earnings before interest, taxes, depreciation, and amortization of $829 million in the second quarter, compared with $820 million in the same period a year earlier. Its earnings growth comes after operational disruptions weighed on the first quarter and was mainly driven by robust exports out of Asia and U.S. demand improvements, it said. but there were still significant cost headwinds of around $600 million in the second quarter arising from the conflict in the Middle East, it added. Revenue for the quarter was $5.84 billion, compared with $5.27 billion in the same period a year prior. Still, Hapag-Lloyd swung to a $173 million group loss for this first half overall, compared with a profit of $775 million in the same period a year before. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Looking at Heard on the Street, financial analysis and commentary, inflation protection is on sale. While far from perfect, these government bonds look like a bargain, at least for the near term. Investors are getting paid what seems like a lot to buy inflation protection for decades ahead, but longer-term bonds also come with longer-term risks. Treasury inflation-protected securities, or TIPS, are government-issued bonds that in the simplest terms pay a yield on top of the rate of inflation. In effect, they offer the protection that an investor's money can at least keep up with inflation plus some extra. Some investors might say, "You had me at inflation protection." What's more, the market isn't setting some enormous inflation hurdle. The yield on a 30-year nominal or regular Treasury bond is over 5.2%. The 30-year TIPS is paying what is known as the real yield, or the rate on top of inflation, of around 3%. That difference is known as the break-even rate. A common way to look at these bonds is to say that as long as the rate of inflation is above that difference, or roughly 2.2%, TIPS will have outperformed an equivalent length regular bond at maturity. That hurdle might seem like a low bar to investors who are very worried about oil, fiscal deficits, artificial intelligence, or lots of other price pressures. But the further out you try to predict the future, the greater the uncertainties become. That makes shorter-term TIPS a better option for most. First, you have to consider the kind of inflation that's being measured. TIPS track the Consumer Price Index, not seasonally adjusted, for urban consumers. This has the benefit of including food and energy costs, things that economists often exclude as they seek to measure core inflation, but which are obviously quite relevant expenses for most humans. The most recent readings of this headline measure was 3.4% year over year in July. The core inflation rate was 2.5%. But CPI is also just one measure of inflation. The cost of key expenses that people might be saving up for in future years, like college tuition or elder care, have at times risen far faster than the index. As a result, you might not ultimately feel like TIPS have fully protected your purchasing power after decades of waiting. Federal Reserve Chairman Kevin Warsh in July said during a Senate hearing that measures like CPI and Producer Price Index are, quote, imperfect measures of the state of underlying inflation. How the CPI is calculated also isn't fixed forever. Historically, it has been a subject of frequent debate and technical adjustments, but making bets based on ideas of future measures of future inflation is, needless to say, pretty difficult. Instead, investors in long-term TIPS should be thinking about inflation forecasts and about the risk that is shared by all long bonds, that future interest rates will be higher. For TIPS, that means focusing on the real yield that is on top of the inflation rate. Even if everyone is expecting hotter inflation, if the level of interest rates is also higher than expected, TIPS might still lose value. Currently, the real yield offered on 30-year TIPS at the market price is higher than at any time in the last several years, getting to over 3%. That high yield is also coming at a time when stock index valuations are still elevated, making the relative attraction of that long-term yield more competitive with equities than is typical. But a lot of forces can drive real yields higher. Depending upon whom you ask, it could be faster economic growth or changes in the supply of or global demand for Treasury bonds. There is also AI's voracious demand for financing, which could drive up borrowing costs as well as its impact on productivity. Any of these concerns could cause investors to price in more risk of higher long-term rates, causing the prices of TIPS and other long-term bonds to fall. That is a risk if you aren't committed to holding the bonds to maturity. So, A lot of investors might want to focus on shorter-term inflation protection. Real yields on 5 and 10-year TIPS aren't at the same level as 30-year TIPS, but they are still near their highest levels in years. 5-year TIPS currently carry real yields of over 2.1%. The break-even rate is 2.2%. Some investors also choose to ladder their TIPS investments with a series of successive maturities to spread their bets over shorter-term and longer-term investment instruments. There are also ETFs that enable investors to buy shorter-term TIPS. At current prices, TIPS give investors good inflation protection and decent yield, at least for the next couple of years. Longer term than that, nothing offers perfect certainty. This is by Telis Demos. Also, Japanese drama is no sideshow for U.S. markets, by Spencer Jacob. 34 years ago, a brilliant young hedge fund manager helped engineer a $1 billion payday for his employer by betting a major currency would be devalued. He made a similar killing 2 decades later. Now, Scott Bessent finds himself on the other side of the foreign exchange trenches as U.S. Treasury Secretary, and it's the sagging yen he's fighting to defend, not the dollar. How he does it matters to investors at home, too. Even speculators with the deepest pockets are veritable Davids when facing government Goliaths, but they have one advantage. It can get more awkward for a country to artificially strengthen a currency than to weaken it. When Bessent helped George Soros break the pound on Black Wednesday in 1992, he reckoned that the country's floating rate mortgages made it politically painful for Britain to raise interest rates to prop it up. Too painful, it turned out. Japan's recent intervention to strengthen the yen without raising its own rates got a very rare assist from America. That's what friends are for, said President Trump. They wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor, he said. Anyway, there's something in it for the White House, too. Japan normally sells some of its huge pile of treasury debt to intervene. The U.S. could have bought yen directly, but it miffed European officials by selling euros instead, in what seemed like a way to keep pressure off the dollar. And future intervention might be done by expanding an obscure emergency Federal Reserve facility that allows it to buy foreigners' Treasury secretaries directly. Keeping Japan's future sales off the markets avoids boosting U.S. bond yields, now near multi-decade highs, at a politically fraught time. That might prevent U.S. mortgage rates from climbing more, and, of course, bond yields indirectly affect stock valuations. Opinions are mixed over how dangerous it would be for the Bank of Japan to just raise interest rates to make the yen more attractive, given its government's world-leading debt pile. It may, though, make domestic bonds more enticing to the country's huge private investors in treasury bonds. As Bessent knows well from his hedge fund days, foreign selling can send a signal that a heavily indebted country like the U.S. has issues too. With federal borrowing on the cusp of passing $40 trillion, you can try guessing the exact day here, Uncle Sam's money problems will be back in the headlines soon. More yen intervention will probably just delay tough choices for Japan. U.S. assistance may also be about postponing some unpleasant financial developments at home. In the money and investing section, Stock Spotlight, shares rose 20% in the Lenovo Group in Hong Kong after the company posted record revenue, driven by artificial intelligence infrastructure demand. At StubHub, shares in the ticket seller fell 10% after the company failed to turn a profit in the second quarter because of climbing costs, despite surging revenue from the World Cup. Cisco, the network equipment company, posted a jump in net income in the July quarter as it continued to receive billions in orders from AI hyperscalers, yet shares declined 8.4% on Thursday. A.P. Møller-Mærsk, the Danish shipping group, raised its guidance despite the conflict in the Middle East. Shares were up 8.8% in Denmark. Bending Spoons, Birkenstock, and Yeti The companies all reported earnings before the opening bell on Thursday. Bending Spoons and Yeti closed down about 16% and about 11%, respectively. Birkenstock shares rose 12%. Workday shares gained 18% after Reuters reported that Silver Lake is in talks to buy the human resources software company. And at Tyson Foods, shares rose 1% after the company said it's planning to close a major beef processing plant and sell another. Kospi enters the bull market. Well, that was fast. South Korea's Kospi index entered a bull market again on Thursday, defined as a 20% rise from a recent low. Since the index's recent bottom on July 30th, it is up nearly 22%, including Thursday's 3.6% gain. That is a quick turnaround. Its launch back into a bull market territory happened over 10 trading sessions. Investors' appetite for AI stocks returned this month. In South Korea, a surge in shares of Samsung and SK Hynix helped drive the Kospi's gains. Analysts at JP Morgan Chase say investor positioning indicates the index may have room to run higher, according to a note from the bank's data assets, an alpha group. But, they added, the lack of levered ETF derivatives participants may mean a slower pace. South Korea took steps recently to crack down on an explosion of interest in leveraged ETFs, risky products that can leave investors with huge losses. The index remains far off from where it stood earlier this year. At its peak, the Kospi climbed 116%. It is up 62% for the year. This was offered by Caitlin McCabe. And in markets and finance, inflation data propels stocks to records. Wall Street now expects the Federal Reserve to hold rates steady, by Jack Pitcher. Prices on consumer and wholesale goods aren't rising as much as feared, and that's been good for stock prices. 2 straight days of soft inflation data lifted the S&P 500 index to a record. On Thursday, the Labor Department reported that wholesale prices were unchanged in July, defying predictions from economists who saw them rising. The reading, which followed a mellow consumer price index report the day before, is resetting expectations about what the Federal Reserve will do next month, and in a positive way for the market. Between the war and Iran's impact on energy prices and a new Fed chair who Wall Street suspects is more hawkish than his predecessor, inflation and high interest rates had reemerged as investors' top concerns. Shifting expectations for Fed policy may contribute to periods of equity volatility, but we expect the global stock rally to continue, said Ulrika Hoffman-Bicharji, global head of equities at the UBS Chief Investment Office. The S&P 500 rose 0.7% to close at a record high for the 27th time this year. The tech-heavy NASDAQ Composite Index added 0.8%, while the Dow Jones Industrial Average climbed 0.1%, or 70 points. Traders are now pricing in a 2/3 chance the Fed will hold benchmark rates steady at its meeting next month. Just a month ago, they saw a 75% chance the central bank would hike. Another CPI report is due before the Fed's next rate decision in December, so it is far from a done deal. For now, outlook looks better. The benchmark 10-year Treasury yield dropped 4.64% on Thursday from a nearly 2-year high of 4.745% on July 31st. Short-term government bond yields, which are influenced by benchmark rate expectations, also dropped and are sitting almost a 1/4% below last month's high. There is a little tiny bit more to this article. If you want it read to you, please call 716-821-5555, and staff will be happy to read it to you. You have been listening to a reading of articles and features from the August 14th issue of the Wall Street Journal. We read from the Wall Street Journal every Monday through Thursday at 11 p.m. and Friday at 6 p.m. Your reader has been Dasha. Thank you for listening.
Coming up next in the Niagara Frontier Radio Reading Service, we have the Buffalo Criterion. At 8 o'clock, we have the New York Times. And at 9 o'clock, we have Discover Magazine. Stay with us for these readings and more. The following program is intended for listeners who are blind, have low vision, or have another print disability which